Hi, this is James Robinson, and this is my stock pick of the week. My pick of the week is simply a stock that I happen to think is a great buy that week. My criteria for what makes a great stock is really simple. I look for great companies with a durable competitive advantage or extremely good returns on invested capital. Only after I find companies that qualify under that criteria do I look at the stock price to see if they're fairly priced. I probably got 50 or 60 companies that I think are very solid companies that I would consider buying, but only at the right price. So I watch those companies constantly and wait for things to happen that make them appear to be well priced. My definition of a great company, a durable competitive advantage, come directly from the study of Warren Buffett and the various investors in his circle, the people that he would call the super investors of Graham and Doddsville. It starts with a book called Security Analysis, written by Ben Graham and David Dodd. What I'm not doing is I'm not looking for the next new thing. I'm not looking at Tesla, even though I think they're great cars. I don't think it's a great company. I'm not looking at solar or some gadget. I'm not looking to turn $10,000 into $1 billion next month. I'm looking to find solid companies who will return good returns on investment year in and year out for the long run. Today's stock pick is T. Rowe Price, symbol TROW. T. Rowe Price is an American publicly traded global asset management company. They offer funds, advisory services, account management, retirement plans, as well as services for individuals, institutions, and financial intermediaries. The firm has $900 billion under management. It's based out of Baltimore, Maryland, and has offices in 16 countries. The firm was founded in 1937 by Thomas Rowe Price. Price was best known for developing the growth stock philosophy. The company went public in 1986 with a $200 million IPO. It was added to the S&P 500 in 1999. As of February 8th, 2019, the company had a market cap of $23.122 billion. It had revenues of $5.37 billion, profits of $1.79 billion. Its PE ratio is 13.37. Its yield was 2.88. However, it just announced an 8.4% dividend increase, which hadn't shown up at this number, so it'll be slightly higher. And important to note, this company has absolutely zero debt. Here you can see my general overview of the company. To recap, I value a company, look at a company based on 29 criteria. Those criteria fall into three broad categories. The first 9 criteria are operating issues. That has to do with how good the company is at delivering its products to its customer. Is it able to grow its sales? Is it able to do that in a manner which is competitive with the marketplace? Are they able to control costs efficiently? The next area is financial, and that really has to do with how well the company is handling leverage and risk, debt and risk. The third issue is management, and that has to do with how good a job the company is doing at enriching its shareholders. Are they paying dividends? Are they buying back stock? Are they paying down debt? The monies that they retain, are they able to get significant returns on that investment? So this company is very, very solid. Lots and lots of, I grade every category on a scale of 1 to 4, 4 being the best, 1 being the worst. This company didn't have a single category where it was a 1. And most of the categories were a 4. It's a very solid company. That I look at is gross margins. Gross margins I've talked about, I consider that to be sort of the altitude for an airplane. If your engine goes out on an airplane, you like to be as high as you can because that affords you the most opportunity to make decisions, find a safe place to land, buys you time to restart the plane. I look at gross margins as sort of the same thing. The higher my gross margins, the more my company can deal with things going wrong either in my company or in the economy and still turn a profit. This is a little bit of a strange chart because the category of cost of goods sold, which is part of what's used to define your gross margins, didn't really exist with this company. They didn't use that kind of accounting until 2008, so the numbers are a little skewed before that, but 2008 to 2017 is still 10 years. So it gives me a good sense. They're above the top 25% year in and year out. So I consider this to be a company with solid gross margins, and again, they're in a very narrow band, which leads me to believe that they're likely to be able to continue to be in that band going forward. So the next thing I'm going to talk about and go into a little depth, every week I'm going to try and go in a little bit into depth into what I'm looking at in a company and why. So today I'm going to talk about earnings. It would seem pretty obvious that I look at earnings. Obviously that's how much money the company makes, right? But one of the things that I look at and I juxtapose with each other is its earnings per share versus the total earnings. So you may think that those things are going to be the same, right? The total earnings and the total earnings per share, they're really just the same number divided by the number of shares. But over time, the company may be buying back shares, or they may be selling shares to the marketplace. So it's possible that a company will, its earnings will be flat, but they'll have bought back shares, and that will make the earnings per share increase. That is a sign of a company that is not doing a great job of managing the business. They're trying to make it look like they're artificially more profitable every year, but really all they're doing is they're using my money as a stockholder to buy future profits. And I don't consider that to be a strong practice. I would consider that to be a sign of a weak management. So that's the kind of thing that I look at. In these two slides, I wanted to show you an example of what I was talking about in the previous slide. First of all, let's talk about the earnings in a general sense. We've got earnings per share and earnings for this company, and they both are fantastic, right? Basically going straight up with very few exceptions. Earnings have basically quadrupled since 1998, so this is a company that's really strong earnings. But, and not to micromanage, but I wanted to call your attention to look at years 2012 through 2015. In those years, if you look at just regular earnings, you see that those 2 years the earnings went down versus the previous year for those 2 years. If you look at the next slide, or the next graph, which is earnings per share diluted, you see that the earnings appear to have gone up for those 2 years. So how is that possible? Well, it's simple. In those 2 years, they bought back enough shares that when you take the earnings and divide by the number of shares, and there's fewer shares each year, the earnings per share appear to have gone up, but the company's earnings didn't. Now in this company, it's really nitpicking, but there's examples out there of companies where this is really dramatic, and you see that the management's doing almost nothing to grow the business, but they're using the shareholders' money to buy back stock, which makes the earnings per share go up, and it appears that the company's doing better and better every year, but really they're just buying that with your money, with the stockholders' money. So I just wanted to call your attention to that in this slide. So the next slide that I'm going to look at is net earnings as a percentage of revenue. This really shows me, for all the dollars that bring in, when all the dust is settled, how good a job does this company do in terms of dropping money to the bottom line in terms of profit. You can see that the green line represents companies in the top 10% of the 800 companies that I've looked at. And you can see that this company, year in and year out since 1998, has always been in the top 10, or virtually always, with the exception of, looks like 4 or 5 years, has always been in the top 10% of companies in terms of converting revenues to earnings. That's a very solid piece of information to know about this company. That means that they've managed through multiple recessions. In fact, even in the recession of 2008, which, by the way, this is a company that does stock market related things, you'd think they would be worst hit by that. But even in that period of time, this company did a great job in terms of turning revenue into earnings. So this is a really good sign about this company. It's one of the reasons that I'm really excited about it. So I've talked in the past about what I call the 4 operating taxes, right? So you sell a company, you sell a product, those are your revenues. Then you have cost of goods sold, that's what it costs you to make the product. Then you have these 4 areas, and really there's 5 if you include interest. There's 4 areas that your company probably has to spend some money on, or may have to spend some money on, that are taxes on your future profitability. The first is SG&A, which is selling and general administrative, and the second one on this slide is plants and equipment. You can see that in both of these cases, these companies are at least better than average. In terms of SG&A, they're effectively in the top 10% of companies. In terms of plants and equipment, again, they're in the top, let's call it 25% of companies, and really much better than that. So this company is doing a good job of managing those 2 cost areas. On the next slide, on this slide, you can see inventories. The company has 0 inventory, so that's fantastic. And it has 0 R&D. So it's in the top 10% of, it's in the top 10% in terms of the cost for plants and equipment. It's in the top 25% in terms of SG&A. And that really lets you know why this company is able to return so many dollars to the bottom line in profit. So this next slide is debt analysis. Let's look closely at this. The first thing is, if you notice that the blue line is total current liabilities, the red line is total long-term debt, and the green is total debt. The first thing you should notice is the company has 0 long-term debt, so that's fantastic. The next thing you're going to notice is that it appears the total current liabilities go up every year, and of course that might initially appear to be a red flag, but it's not, because your current liabilities are a reflection of growing, in this case, a growing business. They have more and more offices, that means they have more and more leases, that means they have more current liabilities, they have more payroll they have to meet, they have more contracts, they have more legal, all these different costs that they have to pay this year that are current liabilities. And so I don't mind this at all. We'll see a later slide that shows you current liabilities as a percentage of revenues and a percentage of profits. This is not an issue for concern. It's actually very, very strong. The most important thing about not having any debt is you don't have any interest. So interest expense, they've had a couple of blips in 2010 and 2012 where they paid a tiny bit, a couple $1 million of interest, but again, it's nothing. The next slide shows you that interest expense as related to operating income. I mean, it's effectively 0%. It couldn't be any better, right? So we love this company because of its financial acumen and financial strength. So last week I showed you that Philip Morris, Altria, MO, had current liabilities that were in excess of their current assets. And I said that that was okay because, while I didn't like it, it was okay because I felt the company was strong enough to provide it. This is the chart that I really like to see. This is a company where current assets are significantly higher than current liabilities and growing at a rate faster than current assets. So this basically says this company has enough money in the bank to pay 3 or 4 years worth of operating costs. If it doesn't make a single penny of profit, it won't have to go into a single penny of debt. Out of its current assets, it can pay 3 years worth of liabilities. That's a fantastically strong company. In fact, you could almost argue, if you had to, this company had too much in terms of current assets and could afford to give even more back to the shareholders. I'm not making that argument, but if you were to make an argument, that's the way you'd go. So this next slide, we talk about dividends, and I love dividends. I love companies that pay dividends. And you can see here, this company's dividends they seem to go up again every single year. We've got a chart in a minute, we'll talk more about that. There's two big blips here, and it looks like their dividends actually kind of go up and down and up and down. They really don't. The dividends have gone up every year, but what happened is in 2013 and in 2016, they gave special one-time dividend bonuses. They gave $1 per share special bonus in 2013 and a $2 per share special bonus in 2016. So that shows up these blips, but effectively they've just gone up every year. And you can see dividends per share, again, has gone up at a rate that is slightly in excess of the total dividends paid, and that's because they bought back shares in the interim. However, when looking at dividends, I don't just look at the numbers. I like to look at the dividends in terms of 4 factors. The factors are yield and growth, dividend safety in the context of earnings, dividend safety in the context of cash flow, and dividend safety in the context of its current debt load. I'm not going to address in this analysis dividend safety in the context of cash flow because it's misleading. This firm had to reassign about $2.5 billion worth of marketable securities from cash and marketable securities to long-term investments due to the way they were held. And I don't need to get into all the financial analysis of exactly what that means. If you're curious, it's on page 47 of the 2016 annual report for TROW. But basically, just trust me that the cash flow numbers are skewed because money was taken out of cash flow to justify that accounting process that happened with $2.5 billion worth of assets. So I'm going to look at dividend safety in the context of earnings. I'm going to look at dividend safety in the context of current debt load. And of course, we'll look at yield and growth. In terms of yield, the stock pays 2.88%. This is slightly better than average. There's not much to write home about. It is, however, solid and secure and safe, and it's something that you don't get if you buy a lot of other companies, and so I'm happy with it. More importantly, over the last 5 years, the dividend has grown an average of 11% a year, so 3 times the rate of inflation. So in theory, if you bought this stock and you put all of your retirement into it, which I don't advise, but if you did, and this company threw enough money for you to be able to retire, you have your retirement get a little bit better every year as the dividends is outstripping inflation. So dividend safety in the context of earnings. The current payout ratio is 38.2%. What that means is, for the total amount of money that's earned by the company, they're giving 38.2% of that to the shareholders in terms of dividend, leaving 62% for them to invest in other ways, retained earnings, buy back stock. In this case, they don't have any debt to repay, but they could repay back debt in the usual case. The average payout ratio for the last 5 years is 41.2%, so pretty consistent, pretty solid, pretty stable. I have no concerns about this company's ability to continue to pay dividends at this clip. You know, the other way we look at these things, and typically it's a bigger issue in this, is we look at dividend safety in the context of the current debt load. The current debt load for this company is 0. So obviously the interest rate is zero, and the amount of money we pay in interest is zero. So in this company, interest is never, regardless of what the interest rate goes to, it's never going to be a problem with this company to be able to pay dividends because they have no debt. And in fact, if interest rates go up significantly, the competitive companies in this industry will have a bigger and harder time meeting their obligations because they do have debt and they theoretically would need to refinance it at those interest rates. So this company has a significant competitive advantage by and through the fact that it has no debt, and it of course makes the dividend extremely secure. So here you can see the shares outstanding. You can see that they've basically been going down since 2007. There was a couple of years where it's gone up a little bit, but basically they've been buying back shares at a pretty significant clip. They've bought back about 10% of the stock in that period of time. So they haven't bought back a ton of shares, but every year they buy back a little, and that's actually been accelerating for the last 4 years. And I would expect that trend will continue. So here we see shareholders' equity. You can see that since 1998, with the exception of 2 years, the shareholder equity has gone up every single year. It's fantastic, it's strong. I really like this company for its ability to create equity for its shareholders. The big thing that I like about this company, and the reason that I would buy it, even though I think it has a less than obvious durable competitive advantage, is because this is the kind of business that requires very little capital to stay in business and to make money. If you look at this chart, this is return on assets. So you take the total amount of money that the company employs, and you say, what are the annual returns on investment for that money? And you can see that it's always in the top 10%. It's been as high as 30%, but it's consistently above 20%. So that has several meanings that really create value for me. The first thing is that I know that every time this company retains money, it appears they continue to generate profits on that money. So that means they're not frittering away the money that they retain. Also, it means that I don't mind if they don't pay out 100% of the money in dividends, because I know they're going to get probably a better rate of return than most of the other investments I'm going to use. Finally, it means the management is doing a very good job of managing costs and maximizing income, maximizing profits. So this is the reason that I would buy this company, even though in terms of a competitive durable advantage, I don't know what T. Rowe Price does better than Goldman Sachs or Fidelity or whoever it competes with. The fact is, they don't care how they do against those companies. If they can continue to generate these kinds of returns, as they've been demonstrating they can since 1998 through all kinds of economies, I love this company, and I think that's the reason this company is somebody you should consider owning. So here you see what looks like the same chart, only we don't compete quite as well as some other companies. This is return on equity. And obviously the difference between return on assets and return on equity is the debt component. Our company has no debt, so it has the exact same amount of assets as it has equity. What you're seeing here is we're always in the top 25% of companies, but we're not in the top 10% of companies like we were in terms of return on assets. That's because there's a significant number of companies out there that are using leverage to goose their returns, right? They're borrowing a whole bunch of money, and that means that they're able to get a higher return on assets because they don't have as much, their equity will be lower than their total assets. They're employing a lot of money, they're also employing debt, and they're getting returns. The problem with that is that that debt can come back and bite you, right? It can be a negative when the economy turns. It can be a negative when interest rates go up. And so while there's companies out there that are getting, the top 10% of companies average 30% return on equity, that's not the same thing as a safe return on equity. And they do great in good economies, which we've been going through, but they'll do less well in poor economies. So I don't mind if we're in the top 25% on return on equity, and I wanted to highlight the differences between return on equity and return on assets so you have a sense of why I look at both. Let's recap. What is T. Rowe Price's product, and does it have some sort of consumer monopoly? I don't think it really does have a consumer monopoly in the sense that I typically look for. But what it does have, and more than makes up for, is a business model that requires very little capital relative to the income it produces. It also has zero debt and solid management. It does a great job returning wealth to stockholders. So I am not as concerned that this company doesn't have a great competitive advantage for like an addictive product like Altria, because this company has a product that I think is going to continue to be in need. I think they do well in their marketplace. I think they employ very little capital and they employ it efficiently. So does the company have pricing power? I don't think it has pricing power in the ability to raise its prices because there's other people it's competing with. But it does have pricing power in that it has a very low cost structure. So if the economy was to turn and its competitors got in trouble, we are less likely to get in trouble, which means we're likely to pick up market share. Also, if our competitors raise their prices, we're able to raise our prices as well, and we have such lower cost structure that I'll go straight to the bottom line. So it means the cost of doing business were to increase dramatically, this company would be well positioned to out-survive its competition and would be well positioned to profit if the market turns the other way. Does the company have a reasonable level of debt? Well, it has zero debt, so I think that's great. Does the company reward its owners? Yeah, they pay a strong and raising dividend. They buy back stock at a sensible clip. They retain a reasonable amount of their profits, and they generate an excellent return on equity. So even the profits they retain year in and year out seem to continue to generate profits. So would I buy this stock? Yeah, at its current price, $97.58 a share, I would recommend this stock, and I do hold it in my portfolio. So I've updated my portfolio of stocks that I own from my picks of the week. There are currently two companies now, MO, which is Altria, and TROW, which is TROW Price. I bought about $10,000 worth of both. I'm not going to worry about what's happening with these stocks because I own one of them for a week and one of them for a day. Over time, we'll start paying attention to this slide. For now, I'm simply charting that we're buying these shares, we own these shares, and keeping track of my previous picks and its suggestions so we can start to track my profits. But really, for the first 90 days, I'm not really worried about the results. I'm a longer-term holder than that, and even if the stock was to go up 20% in the next 60 days, I wouldn't take any credit for that. That's just the typical fluctuations in the market.